For years, investors have debated the ultimate Roth IRA strategy. But what if the answer isn't a complex portfolio, but a singular, elegantly simple ETF designed for maximum tax-free growth, especially in 2024? We're talking about taking your annual Roth contribution, pouring it into a single fund, and watching it potentially become a seven-figure sum. In this deep dive, the data points to one undeniable champion. Let's first quickly reiterate the immense power of a Roth IRA. This isn't just another retirement account, it's a financial superpower. Your contributions are made with after-tax dollars, meaning every single dollar of growth, every dividend reinvested, and every capital gain harvested is completely tax-free upon qualified withdrawal in retirement. Imagine paying zero taxes on a portfolio that's grown from hundreds of thousands to over $1 million. The crucial question then becomes, how do we maximize that tax-free growth efficiently, and why an ETF? Exchange-traded funds offer unparalleled diversification, low expense ratios, and liquidity, making them ideal for a long-term set-it-and-forget-it Roth strategy. They allow you to own a piece of potentially thousands of companies with a single purchase, bypassing the higher fees and often opaque strategies of traditional mutual funds. Our goal here is simplicity married with ultimate efficiency for your financial journey. So, what are the criteria for identifying the best ETF for this critical role? Our channel, Dividend Detectives, is built on data-driven decisions, not speculative hunches. First, an ultra-low expense ratio. We're talking below 0.05% because every basis point shaved off fees compounds into significant, tangible savings over decades. Second, broad market diversification. We want exposure to a wide swath of the U.S. economy, not just a handful of large-cap stocks. Third, market cap weighting. This ensures your investment automatically adjusts as companies grow or shrink, always reflecting the true market sentiment. Fourth, a proven track record from a reputable fund provider. These aren't just preferences, they are non-negotiable principles for long-term wealth accumulation. Let's look at the leading contenders often discussed in financial circles and put them to the test against these very strict criteria. When we talk broad market ETFs, two giants frequently enter the conversation: the S&P 500 index funds and total U.S. stock market funds. Consider VOO, the Vanguard S&P 500 ETF, which tracks the performance of the 500 largest U.S. companies. It boasts an incredibly low expense ratio of 0.03% and has delivered an average annual return of approximately 10 to 12% historically. It's a fantastic fund, covering about 80% of the U.S. stock market's value. However, it specifically excludes small-cap and mid-cap companies. Now let's pivot to VTI, the Vanguard Total U.S. Stock Market ETF. VTI also has a 0.03% expense ratio, but it holds nearly 4,000 stocks, encompassing large, mid, and small-cap companies. While its historical returns closely mirror the S&P 500 over many periods, the critical difference lies in its comprehensive diversification, a truly powerful advantage. This slight difference, this broader net, can lead to significant variations over multi-decade investing horizons, capturing growth pockets missed by more concentrated indexes. The mathematical reality is that while large-cap companies often dominate headlines, small and mid-cap companies can, at times, deliver outsized returns, especially during specific economic cycles. By holding a total market ETF like VTI, you're not trying to predict which segment will outperform. You're simply owning all of it. You're guaranteed to capture the returns of every publicly traded U.S. company proportionate to its market capitalization. This strategy, often championed by financial giants like Jack Bogle, is about accepting the market's return, no more, no less, and letting the magic of compounding do the heavy lifting, tax-free within your Roth IRA. Imagine an investment that automatically diversifies, rebalances, and captures the entire economic engine of the United States. That's the undeniable, enduring power of a total market ETF. Other excellent choices that mirror VTI's strategy include iShares Core S&P Total U.S. Stock Market ETF, ITOT, and Schwab U.S. Broad Market ETF, SCHB, both with equally low expense ratios, generally around 0.03%. Their choice often comes down to your brokerage's commission-free ETF offerings, but their underlying performance is nearly identical. Let's run the numbers and illustrate the sheer mind-boggling potential locked within this strategy. Suppose you're 25 years old and contribute the maximum $7,000 to your Roth IRA every year starting in 2024. For simplicity, let's assume a conservative average annual return of 10% from our chosen total market ETF, consistent with historical market averages. After 30 years, at age 55, your total contributions would amount to $7,000 times 30 years, totaling $210,000. Now, here's where the Roth IRA and the power of compounding truly shine. That initial $210,000 invested consistently into a broad market ETF like VTI would grow to an astounding $1,151,458. That's over $1.15 million. And here's the kicker. Every single penny of that profit, over $940,000, is completely tax-free. Compare that to a taxable brokerage account where you'd potentially lose a substantial 15 to 20% of those gains to capital gains taxes. The mathematical advantage is irrefutable. You're not just saving for retirement, you're building lasting, tax-free generational wealth. So, if you're ready to harness the power of tax-free growth and want to begin your own million-dollar journey, don't just passively invest. Actively review your Roth IRA strategy. Consider integrating a broad market ETF like VTI into your portfolio today. This isn't just about picking a fund, it's about building a robust financial future. Dive deeper into the specifics of expense ratios and tax loss harvesting by watching our next video linked here, where we break down the nuances of optimizing your brokerage account.